Thank you for watching. Please like and subscribe to our channel.
Everyone, and welcome to The Explainer. Today, we are going to unpack something absolutely wild. We're tracing the direct line from a major, multi-month geopolitical conflict overseas straight to your wallet right now. Seriously, we are looking at how events thousands of miles away are actively dictating the price you pay at the local gas pump and even the interest rate on your mortgage.
Okay, let's dive into this. It's a massive question, right? How exactly did a sudden 3-month geopolitical conflict manage to essentially break the global economy and cause just absolute whiplash in the financial markets? You know, the stakes of this 2026 war involving the United States, Israel, and Iran are just monumental, and not just politically, but in terms of global trade and everyday inflation. The economic shockwaves here have basically backed central banks into a corner and left everyday consumers like us footing a really massive bill.
To really get a grip on the economic fallout, we have to look objectively at how this whole thing started. Back on February 28, 2026, the war officially kicked off, with joint U.S. and Israeli military operations against targets in Iran. And in immediate retaliation, Iran announced the closure of the Strait of Hormuz to shipping. Now, if you follow energy markets, you know this is a critical choke point for global trade. Its closure suddenly put roughly 20% of the entire global oil supply at severe risk. Practically overnight, the market woke up and realized that a massive chunk of its energy was just trapped.
And this brilliantly illustrates the immediate panic. By mid-May 2026, the price of West Texas Intermediate, or WTI, crude spiked violently. We're talking a peak of $112.25 per barrel. That was the highest we had seen since 2022. To put that into perspective for you, data tracking the economic fallout shows this massive surge in energy prices ended up costing American consumers over $37.3 billion in extra energy costs. And that was in just a few short months.
Part 1. Roots of the Rivalry. To truly understand this 2026 market shock, we have to neutrally look back at how this historical rivalry was forged. The modern friction really traces back to 1953. That's when the US and UK backed a coup overthrowing Iran's prime minister following his nationalization of the Iranian oil industry. Then, jump forward to 1979, the Islamic Revolution completely upended the US-aligned Shah's government, replacing it with an anti-Western theocracy. This culminated in the US Embassy hostage crisis in Tehran. By 1980, formal diplomatic ties were completely severed. It's decades of intense mutual distrust that laid the foundation for what we're seeing today.
Part 2. The nuclear tug-of-war.
Moving into the more modern era, the focus shifted pretty much entirely to nuclear ambitions and economic leverage. In 2015, we saw a fragile diplomatic breakthrough with the JCPOA limiting Iran's nuclear program for sanctions relief. But then, in 2018, the U.S. formally withdrew and kicked off a maximum pressure campaign of severe economic sanctions. After years of stalled talks and retaliation, 2025 saw those maximum pressure policies fully return, sparking rapid military escalations that, well, directly set the stage for the explosive events of early 2026, completely regardless of which political lens you view it through.
Part 3. The oil price whiplash. Now, what's really interesting about this slide is the sheer chaos in these numbers. Snapping back to the summer of 2026, we go from that May peak of over $112 for WTI, plummeting to just $78.94 by June 22nd. Brent crude mirrored that exact same freefall. Guys, we're talking about a massive, nearly 30% crash in oil prices over the span of just 15 trading days. It is literally one of the most violent oil price swings we've seen in modern history.
So, what was the catalyst for that massive collapse? On June 14, 2026, a 60-day ceasefire agreement was announced. Mediated by Pakistan and Qatar, this halted hostilities and, absolutely crucially for the global economy, it reopened the Strait of Hormuz. The market saw the oil flowing again and essentially threw a massive party, sending prices crashing down. But, as you're going to see in a second, that celebration was completely premature.
Part 4. The inflation paradox. 6 to 8. That right there is the critical number of weeks it takes for dropping global oil prices to actually filter through the system and show up in the consumer price index. Because of this massive lag effect, Wall Street might be trading oil at nearly 30% less than a month ago, but the real economy, you and me, we simply haven't felt that relief yet.
Because of this lag, we're stuck in what's basically an inflation paradox. Think about it. Gasoline prices at the pump are still up 25% year over year. Broad transportation costs, like airlines and trucking, they haven't adjusted their pricing down yet. And the producer price index is still reflecting those older, sky-high input costs. What this means is that core inflation remains incredibly sticky, stubbornly sitting above 3%. So, the CPI prints for July and August, they're going to still show elevated inflation, creating this highly dangerous illusion for the real economy.
Part 5. The Fed's impossible choice. Let's move to and see how this builds into the macroeconomic reality trapping the Federal Reserve.
All of this builds into a brutal trap for the Fed. Right now, the federal funds rate sits at 3.63%, and it has remained entirely unchanged since late 2025. The market desperately wants, and frankly has already priced in, rate cuts. But the Fed? They're staring at inflation data that, because of the geopolitical lag effect we just talked about, still looks way too hot to actually justify lowering those rates.
This creates the ultimate dilemma, an impossible choice, really. If they cut rates, sure, they support economic growth and ease up the massive pressure on the housing market. But they run the terrible risk of re-accelerating inflation, especially if that fragile ceasefire collapses and oil rebounds. On the flip side, if they hold rates steady, they fight inflation and keep their credibility. But they absolutely crush housing affordability and risk throwing the whole economy into a recession. A misstep here could literally lead to the worst-case scenario, a stagnant economy with high inflation.
So the crucial point is how this dilemma is forcing a massive rotation in the financial markets. The winners right now, sectors like tech and healthcare, which act as defensive plays. Gold is shining as a geopolitical safe haven, and airlines are anticipating future margin relief from that falling oil. But the losers are feeling the pain. Oil producers and exploration companies just saw their revenues collapse. The housing market remains totally battered by high rates, and heavy exporters are still dealing with intense global supply chain disruptions.
Which leaves us with this final burning question. With the July CPI print right around the corner, will the Fed take the plunge and cut rates, or is a grueling period of stagflation inevitable? The geopolitical shockwaves of early 2026 are far from settled, and the next few months of economic data are going to determine if the global economy can somehow stick this landing or if we need to brace for a much harder impact. Keep a close eye on the data because this story is unfolding right now. Thanks so much for joining me on this explainer, and I'll catch you next time.